All right. Welcome, everybody. We are the tech guys who invest. And this monthly webinar, we're going to talk about how to analyze a rental property. So, the agenda for you today is we're going to do some brief introductions. Then we'll talk about the importance of investing. And we'll compare it to a popular way of handling money, which is saving. Then Adam will dive into how to analyze a rental, a rental, and then I'll talk about actions for success, things that you can do today to become a successful investor. So I'll start with the introductions. My name is Kevin Galang. I'm in software sales. Outside of that, I focus primarily on mortgage notes. So I'm a mortgage note problem solver. I like to be the bank and solve problems for people aren't paying, but also I like to be the bank where people are paying because there's nothing more passive than being the bank and getting that monthly mortgage payment.
On Amazon Music.
And then I'm also a personal development junkie. I always try to learn self-help. I do all the things like meditate, journal. I do all the things to better myself as an individual. And that is me in a nutshell.
All right, Kevin, thank you. My name is Adam Yulry, and I am a co-host of the Tech Guys Who Invest. During the day, I am an enterprise business agility coach. I help organizations really transform the way they deliver complex products. For example, software. That's what I work with a lot, are software teams. And when I'm not doing that, I'm a multifamily investor, so I focus on syndicating apartments. I am the head of investor relations for Dreamstone Investments, and we focus on large multifamily Class B in emerging value-based markets like the South right now. And also, I put there I'm a servant leader because that really describes who I am as a person. I love to lead other people by serving them and helping them achieve their goals. So that's kind of a philosophy that I've embodied in my own life, and it's just kind of part of who I am. I love to help people, and it's one of the reasons that me and Kevin do these types of things. You know, we're doing this for free. We're hoping that somebody gets some value out of this, and if you do, then we hope that one day you'll pass that on to somebody else in some way. So it's a little bit about me.
Welcome, everybody. For those who have just joined, we're just into the introductions, but we will be able to cover the entire presentation, and we'll open up for questions as we go along as well. So the question that I want to propose is saving investing? And the reason I ask that is growing up, I was taught that you needed to save your money, save, invest in a 401k and buy a house. And that was pretty much how you're supposed to handle your finances. And then I got older and I realized that when you're saving money, you're not investing. Really, when you're saving money, you're actually losing money through things like inflation. We're seeing that now. There's talks about how inflation is going to be a big factor in the near future. I mean, it's a lot of gloom and doom, and nobody has a crystal ball to say on, March 31st, 2021, inflation is going to hit. That's going to destroy the dollar. Nobody knows that for certain, but we are seeing the effects of inflation, and these high yield savings account that yield 0.08 or 0.8% or something like that. It's supposed to be high savings. You're really just losing money. So let's talk about why investing is important. There are three reasons that I can think of when it comes to why investing is important, and I'll use savings as a way to compare it. Right? When we think about investing and versus saving, your saved income is actually active income. Saving is finite. You can only save so much money, and saving does not offer freedom or security. What would it be if you're retired and all you're thinking about is, can I afford this next thing? In fact, I read somewhere in one study that the number one fear for those individuals who are retired, it's not death. It's the idea that they're going to go broke before they die. That is a sad truth that we're living in, and that's proves to me that savings is definitely not the way when it comes to creating financial security. And I love that Chevelle says one of the biggest mistakes she's ever made is to be an ardent investor, an ardent saver, not an investor. So let's transition that mindset there. And things like this are going to do that, networking with people, and we'll save those actions, calls to actions, and actions for success later in the presentation. But let's talk about how saved income is active income, right? The only way you are making that saved income is by working. And I don't know about you, but I don't work 24 hours a day. I would not want to do that at all. And I don't want to work for the rest of my life. But if all you're doing is saving, that means you have to continuously work to accumulate that nest egg, if you will. You need to be working. That's why that saved income is active. But when you invest that money is working for you no matter what it is you're doing. And some investments are going to be more passive than others. Shout out to performing notes or rentals if you have the right systems in place, as Adam will showcase. That money is going to work for you. So you can be out on the beach sipping on a pina colada. You could be out in the snow skiing or snowboarding, and your money's still going to work for you. That's the beauty and power of investing. Invested income has limitless potential. Am I saying you're going to be the next Jeff Bezos, the next Elon Musk? No, that's not what I'm saying at all. But with the skills that you pick up from your first investment, your second investment, your third investment, what's stopping you from getting more than that? If you want more money, a greater lifestyle while you're retired, or even as you're working to supplement your current income, you can just invest that money. And then we can talk about another time investing other people's money, but that's when the true power of leverage can really come into play. But that investment, that invested income is working while you're doing whatever it is you want. If you want to relax and take a nap, who cares? Your money is working for you. And that is another power of investing. Whereas savings is if you save up to $1 million, that's all it's ever going to be is $1 million. In fact, it's probably going to diminish as soon as you hit that number because you're going to have expenses to pay. When we talk about security and freedom, saving is not going to give you that. As I talked about, that number one fear is losing money. Why would you want to be in the position where all you're going to think about is, I have the choice of taking this vacation or saving up for this potential bill? Or medical expenses, anything, any of those rainy day type of situations. It will pain you to say, man, I have to pay for this. There goes this chunk. And now I have to figure out my budget to live through that. Or you can have some types of investments that are kind of hedging that bet against that. You have a nest egg for the emergencies, but the rest of your lifestyle is paid for by the investments. And that is where investing can really come into play. So I've talked enough. We're going to talk rentals, and I want to pass it over to my co-host, Adam Yolry.
All right. Thanks, Kevin. So one way you can invest is in rental properties. And what we're going to talk to you about tonight is one of those ways. And we're going to walk through an example of how to analyze a rental property. And we're going to be looking at a specific type. We're going to be looking at what people in the industry call an SFR, which just means single family rental. It's like a rental house, really, just one unit, not multiple units. And a few things I'd like to talk to you about before we get started on that are what we're calling pro tips, just some things that are very important and sometimes forgotten or overlooked. And sometimes it even happens by people who have some experience under their belt. But once they learn the lessons the hard way, they never forget it again. So we're trying to help you learn from mistakes other people have made. So those lessons won't quite be so painful for you. I'm sure you'll find plenty of other interesting lessons to learn along the way, as we all do. The first one is never rely on pro forma numbers. So it's important not to trust the numbers that a seller would give you. And that includes a broker or an agent of some sort or a wholesaler. And the point there is always do your own due diligence. Always verify everything they're telling you, no matter what. That's very important to do. Even the small ones, by the way. Sometimes that's where people kind of mess up a little bit, as they'll think, well, that's just such a small thing. And I think you'll see when we go over the analysis how just little small things add up surprisingly quick. So always run your own numbers. The property must cash flow. If it does not cash flow, then you don't want to do that deal. unless you're some more of an advanced, sophisticated investor who has specific reasons why you would want to do that. That doesn't apply to most of us, especially when we're getting started. So my advice for you is when you do your analysis, if it's not cash flowing monthly, I would move on to a deal that is. Part of what Kevin talked about there, in fact, almost all of what Kevin talked about there is passive cash flow, which is not going to happen if when you do your analysis, the property doesn't cash flow. Okay. The next thing is appreciation. Make that icing on the cake. That is not what you're going after. You're going after cash flow. Hopefully, the property will appreciate. Historically, odds are it will. Consider that icing on the cake, but that's not the reason for investing. So don't let that factor into your decision when you're talking about making an offer on the property. That's not what you're looking at there.
Yeah, is the
Using
appreciation going to be paying down your mortgage, or will the renters be paying for your mortgage if it cash flowing? So it's one way to think
right.
about it.
Yeah, good point. Appreciation doesn't pay down your mortgage. All right. So I like that, Kevin. When I'm saying use ink, not pencil, I'm talking about when you're analyzing your property and you're confident in your numbers, never change your numbers to make the deal work. So if you were doing this in the old days with a pencil on a notepad, you might erase one of those numbers and say, oh, well, if it wasn't 10% CapEx, if it was just 5%, or maybe if it's 5% property management instead of 10%, I'll just erase
But what
that.
if that's your budget and you're just trying to set your budget?
That's a great question. The answer would be if the deal doesn't work within your budget and the numbers you set, then it's not a good deal for you. That's the answer there. Good question. And then the last thing is the numbers don't lie. So when you're looking at this, it can be tempting to just sort of wonder, especially if it's the first one you've done, or maybe the second. And it's important, once you feel confident in your criteria and your analysis, rely on your numbers. Don't rely on what the wholesaler tells you or something like that. Okay. So I've talked enough about this. Let's get into an analysis. Okay. All
Let's
right.
play
So
a game
Kevin's going to
called
turn
Will It
this
Cash
over to
Flow?
me.
What's the prize?
The
Good
prize is
question.
knowledge.
Knowledge, exactly.
And that's the most valuable thing we could possibly give you, right? All right, let's see here.
And if you have any questions throughout this process, please don't hesitate to ask. We're more than happy to provide, answer the questions to the best of our ability.
Yeah, absolutely. Can you guys see a spreadsheet that says buy and hold cash flow and ROI calculator?
Yes, we can.
All right, awesome. Okay, so we'll start at the top, and I'm just going to kind of step through this as we go pretty slow through this, okay? Buy and hold cash flow calculator is just a little Excel spreadsheet that I put together. I actually got the origins of this. It's been slightly modified over the years, I guess. But originally, I actually got this off Bigger Pockets website. So, if you're on the Bigger Pockets website and they have a cash flow calculator, they actually made it into an application, I think. So they're no longer using this spreadsheet, but that's where I originally got this. And you might be surprised at how simple it is, but really, this is all you need. So let's start off with the price of the property. So first of all, what we're modeling here is a sample 2-bedroom for $90,000. I found one. I just went out on Craigslist and actually found a property for sale. Or no, actually, you know what? I got this one on Zillow. Found this property on Zillow and just thought, why don't we just plug this in and just kind of see what the numbers look like. $90,000 was the asking price. Now, if you look in the area and run some comps, which there are some ways to do that, although it's beyond the scope of our little lesson here tonight about how to do that. There are several methods for getting comps, but what I was able to do is determine that the after repair value for a house in that neighborhood was at 130. Now, that would be for a house that's completely fixed up and in full retail selling condition. So it's been completely remodeled and all of that. This house we're looking at here, it was not in that condition. It needed some repairs. It looked pretty dated. And so that's kind of where you're going to start. Okay. So one of the things you need to do is figure out how much money you're going to put into it. Okay. So when you go look at the house, you can figure out how much money you want to put into it to get it ready for the types of renters you're going to be attracting. I'm not going to go into strategies for how much repair to do on a house, but I would just say make it rental house quality. Don't over improve it with upgraded luxury type finishes and features and things like that. Okay. You're
Do you
really
need a
going for
performer for
durability.
that amount as well? Like, how do you figure out that amount? Do you have to set up like a budget for it as well, construction?
Yes. So a good question. Row 5 here is this. That is what you're asking about, repairs. So when you go decide how many repairs or upgrades or fixes you want to do to the property. So that is going to include those things. It's going to include things like, if you want to replace the faucets or a vanity, if you want to get some painting done, don't forget you're going to have the place cleaned, all of that. So if it were $50,000 worth of repairs, you would plug 50 in here. In this sample, I estimated 10,000 just for the sake of an example.
But it's also,
it's
to your point,
fictitious.
Adam.
Yeah.
To your point, it's knowing who you serve, right? If you're going to turn
Right.
this into a class A luxury marble countertops and floor to ceiling window type of things, then have that into your budget. But will that be the appropriate best use of that money for a repair? Right. So I think keeping that in mind is also part of the budget.
Absolutely. Yep, that's right. So for our example, we just said, let's go with 10,000. So if this were real life, I would have gone to the house, looked through it, maybe with a contractor, and came up with, oh, hey, I think for $10,000, I can get the inside repainted, a few of these little things fixed, get the hedges trimmed, and I think this thing will make a nice, clean little rental property. Okay. To factor your purchase closing costs in, they're, like a rule of thumb is 3%. So again, do your own due diligence. But for the purpose of this exercise, I said a 3% will handle all of the closing costs that we're going to encounter with this particular transaction. Okay. And that's 3% of the purchase price, by the way. And so then we have to figure out how much, if any, we are going to borrow for the property. So a big lever in investing is to leverage someone else's money, to leverage the bank's money, especially nowadays with interest rates being so low. You would be missing a big opportunity not to borrow money to buy an asset. Okay. So I just went with kind of a standard 80-20, which means the bank is going to want me to put up 20% of the purchase price, and then they will loan me 80%. Okay. I mean, that's kind of a standard loan product. So making some assumptions here about what loan product to go with. And my assumption was I could get a 30-year fixed 80-20 loan for somewhere around 3.85%. Okay. So to do that, that means the loan amount's going to be 80% of the 90,000. So that's 72 grand. And then my down payment right here, 20% of that is 18 grand. So that's how I came up with the 18. So my total investment at this property would be 102 grand. Okay. So to factor the total investment, we're saying, well, how much are we paying for the property? How much are our closing costs? and then how much repair. That's all in, right? So that would be the total investment amount. Now the total loan amount, that's going to be 72,000. Now, the other thing I need to figure out is how much I can rent this thing for, right? So a little homework, and I can discover how much market rent for a 2-2 in this neighborhood is. And several ways to do this. You can check with property managers. That's a really good way to do it. You can check with a few different tools online and kind of cross-check them. So you could look at Zillow and see how much things are being rented for in an area. You can check Rentometer. I like that one. And
Me too.
you can check a few tools like that. So I think on Rentometer, I checked this one. It was $8.95. So that's what I went with. It was just kind of the middle of the road. Okay. So
Adam, are you of the mindset to be more conservative with your numbers, or are you kind of play in the middle? Where do you stand?
Yeah, I'm definitely more of a conservative type, just because I know little things can kind of add up quickly to, it doesn't take long for your cash flow to be eaten away by those little things. So I like to go conservative. And then if I'm wrong, it's usually in my favor, and I'll actually, get more cash flow than I was expecting. That's better than the alternative.
Fair enough. I agree.
Yeah. Okay. So we're right down here to the part where we talk about what our monthly mortgage and all of that stuff is. Now, before I go into that, I would like to ask if anyone has initial thoughts before seeing us continue with the analysis and go through the rest of it. If you saw a $90,000 2-bedroom house and you thought I can rent it for $8.95 a month, would you think that would cash flow?
All day.
Okay.
Absolutely.
All right. Awesome.
No, not at all.
Okay. I'm
Ooh,
hearing
it's split.
yes and no. Okay. That's good. All right.
I love it.
So we'll
We'll
keep
let
going.
the numbers tell the story.
Exactly. And that's what we said when we said the numbers don't lie. So whatever they are, right? Okay. So as I said, the interest rate 3.85, and it's a 30-year, just kind of a standard 30-year fixed loan. And what that gives us here on a $72,000 loan amount is a $337.54 a month payment. Okay. $337.54. Now that's really low, right? In fact, when you look at that, you may be thinking, whoa, the difference between $8.95 and $337, heck yeah, right? All right. So that's what a lot of people think. But this is why it's important to do a good analysis on your property. First of all, you have to account for insurance. So what you'll want to do is actually talk to an insurance agent and get a quick quote. That's the best way to get a feel for what insurance will be. In this case, we're looking at $100 a month. Now you may be able to get a little bit better than that, honestly, but it's going to be real close to that. And then property taxes. So here's another one that is very important, and most people kind of miss this. So for property taxes, what you will want to try to figure out is the property taxes you're going to pay when you buy this property, because a lot of times you can't rely on what's on the county assessor site that the owner has been paying. That could be based on the value of the property being much less than what you're going to purchase it for. They will base the property taxes on what they paid for it, or it possibly has been adjusted a little bit over the years, but it's still not going to accelerate at a rate anywhere close to how much the property is appreciated, if that makes sense. So what you need to do is figure out how property taxes are calculated in the county in which you're buying, and apply that to the purchase price you're going to be paying for this. Okay. Now, I've got a little formula I got from somebody that works pretty well for properties in Pinellas and even Hillsborough and the neighboring counties. So what I came up with here was 221 for property taxes. There's a millage rate that you use to apply. That they kind of gave me that. But if you're not sure, you can call your county assessor and ask them how you can figure it out, and they'll kind of help you out a little bit. Okay. So, that
There's
tax is actually,
also, if I may, there's also some, on each county's website, there's also a tax estimator on like Hillsborough County has a tax estimator. I will say though, the numbers that they give are very, very broad. It's a broad range, but so you have to take in consideration whether it's your homestead and things of that nature, but it does give you a broad range.
Excellent. Thanks, Chevelle. Appreciate that. All right. And then, so we got our insurance and our property taxes added on. Okay. Here is, I would say, the number one thing that people, especially new investors, do not factor in. And that is going to be your maintenance, your property management, your CapEx. Okay. And you have to figure that stuff in, because there's a chance you may not want to property manage it forever. So even if you think, if I just drop the property management fee, this thing works all day long. But if I leave it in, it doesn't work. But the problem is, you may get tired of managing that in 6 months or a year or 2 years, and you want to be sure this works for you. So you can always just get a property manager if you need to.
So how do you recommend that we figure out these other numbers? For instance, in my situation, I was doing all this in Denver. Now we're in Florida. So I want to get a better estimate of what these would look like for me in Florida. Do I just start talking to contractors and figure out these numbers? Like, how can I do this a lot quicker? It's a lot of work.
Right. Yeah, you're right. No, it is a lot of work. So it is, I usually use a percentage there of just like 10% of the rent rate. And I mean, it's kind of
total expenses, 10% of the total expenses, or just
no, 10% for your maintenance.
Okay.
So yeah, 10% for your maintenance. And that actually seems to work out pretty well for from what I've seen, because you're going to have things that you kind of don't really see coming, that are not huge things, but you still have to pay for them, and you may not get them all in the same year. So like that, that 10% could potentially not look so bad the one year, but then the next year it sort of catches up. So I think that's a pretty good one to use. And then also the 10% for CapEx is good to do. And most people don't do that one. But I do that to stay conservative, because I'm putting a roof on my rental property in Clearwater right now. Like, there are roofers over there right now putting a roof on that thing. So if I didn't put this figure into mine, I would be coming out of pocket for that somewhere, right? But since I factored it in, I was able to kind of save up for that. And then property management, which I mentioned. So 10% property management. And the reason
10%
is
for property management, that's a lot.
Yeah.
We charge 5% in Denver.
For single family properties?
Not single family, commercial.
Right. Yeah.
Oh,
Well,
so it's more for,
we're paying 3% on my apartment buildings, but on my rental house, where my property manager only manages one house for me, it's 10%.
Oh, wow. That's a lot.
Yeah. It is. And okay. So, and then your other 10% can cover like the any kind of utilities or HOA, if you have that sort of thing. If you don't, factor it in based on what you're going to experience on that property there. Like if you're not paying water, or if you're not paying for some of those types of utilities, if you're not paying an HOA, things like that, then maybe that'll adjust a little. Okay. But for the purpose of this, I just left it at 10. All right. So now we've got our total monthly expenses that don't include the mortgage are at $679. Our total monthly expenses with the mortgage are at $1,016. So what we've done is we've taken the $679, we added our little $337 monthly payment onto it.
Does that include the interest in the principal or just interest?
Yeah. Yeah. That
interest.
is P&I.
Okay.
Yeah. Yep. That's everything there. And then our income, as we said, was $895. So we simply subtract our expenses from our income, and what we get is negative $121.54. So we're cash flowing, we're bleeding money every month. We're cash flowing negative. It's costing us $120 a month. So that, of course, is going to, that's going to give us a negative annual cash flow. And that's going to make all of our returns negative, of course.
So would you do the deal?
No.
Well, I would have done commercial
now-
to begin with.
Well, now I'm tempted to get my pencil out and start erasing so I can make the numbers work.
Right.
Do you think it's wise to invest in residential at this point? Because I'm hearing mixed reviews on that. A lot of people say it's the best time to start investing in residential, but I'm still going commercial. I'm like commercial.
Right. Well, I'm biased, but I think it depends on the area you're in. And if you can, if you can find deals that cash flow, I would say, why not? That's a trick. I mean, I know here in Tampa, I can't find any. So, I don't know about other people, but everyone I've talked to says they can't.
Have you looked in Montana? I've heard Montana, Tennessee, but they told me to use LoopNet to just keep looking for areas out there, Montana and Tennessee in particular. But I don't know how to get in that market. You know what I mean? It's still a certain barrier for me to get in that market.
Right. Yeah. Yeah. I mean,
when you say commercial, do you mean multifamily or do you mean commercial?
No, I mean commercial tenants like doctors and
offices,
gyms, offices. Yeah.
Okay.
Yeah.
Yep.
But I'm open to hearing other, why it would be better to do residential. Like I'm exploring everything at this point.
Kevin, as we talk about this, I'm going to turn it over to you, just FYI. So when you said commercial, I mistakenly applied my own bias to that and thought you meant commercial multifamily, because anything over 5 units is considered commercial. So I thought that's what you were talking about. Yeah, I'm not sure. I don't have experience investing in commercial retail or other types of commercial office or any of that. But, multifamily, I'm a big fan of that. Although I will say, of course, it depends on the market, because we've essentially stopped buying properties in Tampa. We haven't stopped looking, but we're not finding anything that is even close to penciling out for us right now.
We just moved to Sun City Center from Denver, Colorado. So you can imagine how that went. But we did our research, and this is the area that we nailed it down to as far as investment. Obviously, we have a family, just all around like cost of like living versus working. You know what I mean? Just like the overall ambience of this area. Like we looked at everything, and this is where we settled on. So we're hopeful that this area is going to do well, because I'm looking to invest in this area. But again, I'm keeping my eyes and ears open to other opportunities. So our 1031 exchange company recommended Montana for whatever reason. A lot of his clients are looking out there, and I feel like they are the most plugged into that. But now I'm like curious, what is in Montana? And should I go there? Should I go to Montana? Let's go.
Can I jump in here? I'm sorry I'm late. I had a flat tire.
Oh.
Can I jump in to
Of course. Yes.
I've owned a duplex and been a property manager for 20 years. Right now, the market is crazy all over. The prices are high. The city that my unit is Madison, Wisconsin. And my value has doubled in the last 3 years, and I can't believe it. I could
Wow.
sell it right now and make a lot of money. I don't want to do that because there's capital gains. And I don't know if this is even pertinent. But everything around me, everything in the city of Madison is just ridiculously priced, and people are buying. Part of it is getting out of the high-rise apartments and so on, and getting away where you can have your own yard and you can be outside. Because have you covered this already?
No, we
So-
haven't,
Nope,
but
no.
go for
Not
it.
in depth. Okay, well, we don't have to in depth. I mean, it's obviously people want to have their own place so they can go outside and not be confined in a small apartment or a larger apartment, but you have all kinds of other people living around you. I think that in a year, those people who have bought that really couldn't afford to, that is going to be the best time to buy.
Yep.
Yeah, I've heard that from several other
And it's
people as
in
well.
Montana, people are buying second houses or maybe even third houses there and selling their ones or trying to get rid of them if they have property that is near the coast. The
What
coast.
area in particular? By the coast?
Well, I don't know what area in Montana. I think another place to look would be around in Colorado. I think you said you were in Colorado.
Mhm. We're in Florida now.
Near the ski hills.
Excuse.
But further out. I have a friend who has a rental unit that he just rents. It's just an apartment and two apartments in a building.
Mhm.
And he's renting it out to people during the ski year, and he doesn't have to rent it out anymore.
Oh,
He
nice.
just takes
Wow.
care of the people during the ski season, and he's done.
Yeah.
And he's doing the repairs.
That's a good gig.
So that is something to think about.
I was going to mention, Karen, because you said about the capital gains tax. Joe, look into the 1031 exchanges. They explain it. A company will explain everything so well to you, but basically you don't pay taxes on any of the proceeds if you reinvest it into a property of similar or higher value, depending on the bank and stuff. But that's
I've
what we're.
heard it. I've heard about it, and I know what you're talking about. But after 25 years, no, 30 years, first working for other landlords and now being a landlord myself,
Mhm.
I cannot find good renters for my lovely duplex.
Mm.
This year, they're both nuts on both sides.
Mhm.
Last year, they were both nuts on both sides. They think I have a lot. People, the good old, you have a lot of money, so you can fix it if we break it. So
Jojo.
the second thing is when I bought the property 20 years ago, whoops. I don't know who else is here listening, but when I bought the property, should I wait for her?
No,
Okay.
that's okay.
When I bought the
what we can do
property
is
20
connect.
years. What?
Yeah, we could
I'm sorry,
connect you
Karen.
guys.
Go for it. Go ahead. Just go ahead and finish your story. Then we'll
Okay,
move
I'll
on with
just
the
finish it.
presentation.
When I bought it 20 years ago, over the last 20 years, I exchanged out and updated everything. This year was finally the good kitchen on the other side, the second side. Now I'm starting over again. I've had the water heaters go out last year and the year before. This year is some electrical work and some plumbing work, and I'm starting all over again, which I've heard too, but it is paid off. And I am glad for that. So that's my 2 cents worth.
Love it. I'm glad that things are working out for you. There's
Oh
something
my
to be
gosh,
said about
yes.
being in the game versus trying to time the market. So I love that.
And I'm also handy. I'm not afraid to try. And I have changed sinks. I have fixed toilets. I put in lights. That was the hardest part. I'm not afraid to try to do the repairs myself. And for the first 10 years, I had to, oh my gosh, have I painted. But I
Okay,
now have a
Karen.
good contractor that works for
Karen.
me, and I'm going to
wanna-
let it go at that.
Thank you. Appreciate
welcome.
that. We want to finish a couple more slides before we run out.
But speaking of that, to Karen's point, a lot of that is action. So what are the calls to action for all of you on the call? What to do next? And we really have 3 pieces of calls to action for you. The first would be to keep learning. What we're telling you obviously is the surface level. We wanted to show you how the numbers worked, to get the gears turning, to start looking at the numbers and not get emotionally involved. You may see a property and say, oh my God, this looks cute. I love this. I love the neighborhood. I want to buy it. And then you do the numbers. It doesn't make sense. You'll feel yourself starting to say, well, I didn't write this in pen. Let me see if I put this much more down, or let me fudge the numbers. That's going to come with, you'll learn why you shouldn't do that. The numbers will speak for themselves. But learning more, whether it's through our podcast, the Tech Guys Who Invest podcast, the other podcasts that are out there, books, networking with people, learning from others that are in the space is going to be an advantage for you. Keep analyzing deals. Adam found this one, I think you said on Zillow or Craigslist. But when you have the calculator, which we will share with you, get used to plugging in those numbers. If you need to figure out what the taxes and insurance might be in that area, that is an exercise for you to do the homework. Because then if you decide to focus on a specific state or zip code, you'll get familiar. You'll be able to look at the numbers and say, oh yeah, I know this is going to work. And then you'll let the calculator prove it to you that it does work. Networking. Going to events like this, or when things open up, to be able to go ahead and network with people, there are opportunities that other investors like, yeah, I'm looking to sell this rental. Well, if the numbers make sense for you, you can do that. I've purchased some of my notes through other investors by letting them know this is what I'm looking for. So that's just an example of how networking really does pay off. And we just want to recap what we've covered. So saving versus investing. I hope you're convinced right now that saving, yes, is important to have that emergency fund, but to save as a means of securing yourself and your family financially is not the way to go. And Adam, with his expertise, dove into how to analyze rentals. He gave the pro tips of that, and we'll share this recording with all of you as well. He gave the in-depth analysis as to how we can use a calculator to get the numbers on a rental to see if it makes sense to do the deal. Personally, I hadn't seen the calculation, so I thought, yeah, we're going to cash flow. Turns out we were not cash flowing. And I felt myself saying, well, what if we estimate the repairs differently or something along those lines, just to make sure we can make it work as opposed to it working itself. Then those calls to action, right? We don't want you just to see this presentation and go, okay, awesome, and then go back to what it is you were doing. We hope to really inspire you, whether it's reaching out to us or reaching out to people in the meetup group, whatever the case may be. We want you to start taking action for yourself, because that's really what it's going to take, you taking action to take control of your financial success. And okay, there's one more call to action. Connect with us. We'd love to connect with you. Send us an email, add us on LinkedIn. Let's connect. Let's see how we can add value to each other and how we can help each other further our investment journey. So if you want to reach us, shoot us an email, techguyswhoinvest@gmail.com. Don't forget to subscribe to the podcast as well. And this is just a little bit about us. And if you want to share your email address into the chat, like Luz did, feel free to do that. And we'll find a way to get that information to all of you as well. And if you're trying to figure out what it is you want to do, how you want to invest your money, we created an investor identity canvas because Adam and I both suffered the shiny object syndrome, where you hear something cool on a podcast. Somebody talks about notes. Somebody talks about multifamily. The next person talks about Airbnbs. And I will tell you, each of those guests is making money, but each of those guests is a different way for you to sit there and think, oh, I can do this. Oh, I can do that. But you won't make any money if you keep jumping from one thing to another to another. You have to pick something to focus on. So we created that canvas to kind of help people navigate through that. So if you want that, all you have to go to is tgwipodcast.com/canvas. We'll put that information in the meetup as well. And if there are any questions, we'd love to open up the floor. We know we got a couple of minutes left. So feel free to ask us anything that you would like with regards to investing, podcasting.
Have you guys considered? Sorry. My name is Luz. Just moved to Florida, Colorado, Jersey bred, Dominican. I have my own accounting firm. I'm getting involved in real estate. My entire accounting experience has been within real estate. So now that we're running into a little bit of money, we are looking at a lot of different options. In particular, me, I'm looking at every single option. I have that syndrome you're talking about, so I need that bonus sheet. But I'm also considering the pot industry. You know, I saw what it did in Colorado. I saw how we benefited from it in Colorado, and I want to do the same thing in Florida. And you know, it's a risky industry, but for me, it's like it's not a risk whatsoever. Like we've seen what it's doing. It's slow, but it's getting there. More so than other pharmaceuticals and stuff.
Yeah, I am not an expert on the business as a whole. I do see that there is promise. I'm not going to pretend to try and say anything educated. My only concern is at the federal level, how that still affects it, federal versus state. Again, that's why, as you can tell, I'm ignorant to the subject, but that's probably how I would approach it. Do I think it could be viable in the future? Absolutely. But I don't have enough knowledge to tell you one way or the other.
Yeah, same. I focus on real estate, and that's kind of where I place my focus. So I wouldn't be able to talk about other businesses.
Well, real estate,
I've-
I was thinking of because it's so hard for them to get, leases, purchasing real estate